Hi everyone! Quick update to my Chagee video after the Q2’25 release. Since the print, the stock dropped about 13% in a single session, so I will break down the quarter, step back for a longer term view, and finish with how I'm positioned. On demand, Q2 GMV came in at 8.1 billion RMB, up approximately 15.5% year-over-year from 7.02 billion RMB. A clear positive, the network's sales volume is still expanding. But in Greater China, average monthly GMV per store was about 404,000 RMB versus 538,000 a year ago, approximately minus 25% year-over-year. Same-store GMV is also approximately minus 23%. So the network keeps growing at the top line, but unit productivity stepped down on a tough comp. Why? Two main drivers. The delivery platform subsidy war, Meituan JD. Stat coupons reset price expectations and push traffic to the cheapest ticket. Intensified merchant brand promotions. Many rivals layered their own discounts on top of platform deals, which amped up competition and trained customers to chase promos. Chagee chose not to discount to protect its premium positioning, near-term volume headwind, long-term price integrity. Plus, my inference. As the map gets denser, some intra-brand cannibalization is possible if demand doesn't scale as fast, especially while low-cost rivals ride promos. And management also flagged Q2’24 as an unusually strong base, which makes the year-over-year delta look harsher. Alright, switching gears, let's look at the P&L and EPS. GAAP net income got slammed by IPO-linked stock compensation. 77 million RMB this quarter versus 629 million RMB a year ago. If I strip that non-cash SBC out, non-GAAP net income is about 630 million RMB in both Q2’24 and Q2’25, basically flat operationally. The big swing factor is the share count. Diluted shares jumped from 100.6 million to 171.1 million. Most of that is the IPO plus preferreds converting, with a small slice from dilutive awards options. You also literally see the preferreds disappear on the balance sheet. Mezzanine equity went from 933.8 million RMB to 0 in June 25. That's the IPO conversion. Put it together, non-GAAP diluted EPS is 3.3 RMB versus 3.55 RMB last year, approximately minus 7% year-over-year. GAAP diluted EPS is 0.35 RMB versus 3.55 because the SBC hit stays in GAAP. One trap. Don't divide the 630 million RMB consolidated non-GAAP by shares. EPS is calculated on non-GAAP net income attributable to ordinary shareholders. That's why EPS dips slightly instead of collapsing even with dilution. Looking ahead, management says equity comp will remain important and may increase, so SBC is structural. This quarter's dilutive overhang from awards, options is 2.54 million shares, approximately 1.5% of diluted. A snapshot not an annualized rate, worth watching. On the balance sheet side, here is the cash picture. Quick cash check. Since the IPO, the cash pile jumped to approximately 8.89 billion RMB at June 30, from 4.87 billion RMB at year-end. You also see approximately 3.04 billion RMB in from financing this quarter, essentially the IPO proceeds. The NASDAQ listing raised USD the company earmarked for network expansion in China and overseas, plus brand marketing, supply chain, and IT, consistent with using offshore USD to fund overseas build-out. Operationally, the footprint keeps moving. Now, quick store update. In Q2, Chagee added 357 stores and finished at 7,038. That's approximately plus 5% quarter-over-quarter and plus 41% year-over-year. Greater China did the heavy lifting, plus 318 stores, approximately plus 5% quarter-over-quarter, and overseas added plus 39 to reach 208, approximately plus 23% quarter-over-quarter. By market, Singapore is still the benchmark, about 1,500 cups a day per store, with major payback under 12 months. Malaysia is running ahead of plan on profitability. Thailand is rebuilding nicely at 800 cups a day. And in the US, Los Angeles, early reviews were mixed, but sales are about 1,000 cups a day. Not Singapore levels, but solid traction for a brand new market. They also hired senior leaders in North America, which says they are leaning in. And finally, Indonesia. They opened 8 stores. That said, rollout could slow near term, given what's happening in the country right now. Now zooming out, what does all this mean for the bigger story? Big picture. First, China per store momentum is under pressure, not just on platforms, but with many brands stacking their own promos. That trains customers to chase price and amps up competition. Chagee chose not to join in, preserving brand equity. Second, the footprint keeps expanding and there's still runway relative to mega chains. And third, if promo intensity cools, price-driven buyers usually churn and brands with real loyalty tend to win back share. So I will watch competitive intensity and any cannibalization as the map gets denser. Now overseas, first, it's still a small mix, but openings and early reads are encouraging. Second, the US looks better than feared for a beachhead, even if mass scale isn't proven. And third, with fresh USD from the IPO, they can fund builds and shore up supply chain IT, leaning where unit economics work and pacing the rest. With that backdrop, let's talk about valuation and what I'm doing. Even after the post-IPO dilution, the sell-off has pushed the stock back to modest multiples on my math. On my adjusted EPS base of 14.86 yuan, if I extend this quarter's EPS decline minus 7% across the year, i.e. carry the quarterly drop forward on a full year run rate, I get approximately 13.82 yuan. at the post-earning close of $19.11, approximately 136.27 yuan. That's a PE of 9.9x. If I'm stricter and include SBC with a 10% haircut, EPS is approximately 13.37 yuan, implying a PE of 10.2x. So the stock isn't expensive here. But what did the market dislike? 3 things. First, adjusted net income was flat, not what people wanted. Second, no guidance, management is focused on execution, which leaves more uncertainty. And finally, stock-based compensation, my biggest red flag because dilution can stack up. Not financial advice, but personally I'm planning to add gradually. Valuation looks attractive, but the trend is down, and DCA into a falling name is like surfing against the tide. The slide can continue. My bet is on a repricing later, but I'm keeping this a small position and I will happily keep averaging in unless upcoming quarters show dilution running too hot and profit growth not keeping up, in which case I'd reassess. Thanks for watching this update until the end. If you found this analysis useful, feel free to like, subscribe and share this video. Interested at today's price? Let me know in the comments. And if you are into consumer brands, check out my video on media, acquired competitors with serious global reach.